Imagine for a moment that you have done everything right. You worked for 40 years. You saved. You invested. And you arrive at the doorstep of retirement with a portfolio worth $2 million. To most of the world, you are rich. You have won the game. But then you sit down with your financial advisor, and he tells you the truth about the math. He says, okay, to generate the $100,000 a year you need to live, we are going to have to sell off 4% or 5% of your portfolio every single year. And suddenly, the victory turns into anxiety. You realize that your entire survival depends on the stock market going up forever. If the market crashes in your first year of retirement, you are forced to sell your shares at the bottom just to buy groceries. You are cannibalizing your own future. This is the nightmare that keeps the wealthy awake at night. It is the fear of outliving your money. But what if I told you there is a different way to construct a portfolio? A way where you never have to sell a single share of stock to pay your bills. In this video, we are going to build, step by step, what I call the never sell portfolio. We are going to analyze a real-world portfolio constructed for a retiree who needed exactly 5% yield. That's $100,000 in cash flow without touching the principal. But we aren't just looking for income today. We are looking for something harder to find. Income growth. We need a portfolio that gives you a raise every single year to fight inflation, so that 10 years from now, your income is higher than it is today. We are going to break this down into 3 pillars. The foundation, consumer staples that grow their dividends. The accelerator, high-yield engines to boost our cash flow. The landlord, real estate assets that pay rent without tenants. We have analyzed 20 specific companies that fit this criteria. We are going to look at their valuations, their risks, and exactly why they belong in a never-sell portfolio. Stop hunting for returns. Start farming for income. Let's begin. Pillar 1. The foundation, consumer staples. The first pillar of our portfolio is the foundation. These are companies that you likely use every single day. They are not exciting. They are not going to double in price overnight like a tech stock. But they have one superpower: pricing power. When inflation hits, these companies simply raise their prices and you keep buying their products. This allows them to raise their dividend, which protects your purchasing power. In our analysis, we identified several key foundation stocks that are currently trading at attractive valuations. The first one is Keurig Dr Pepper, KDP. Now, this is a fascinating case study in valuation. Historically, this company has been a fast grower, with earnings growing at over 20% in the past. But recently, that growth has slowed to about 11%. Here is the trap most investors fall into. They look at the stock price over the last 5 years and see it has gone nowhere. It has basically flatlined. They think, this is a bad stock. But as value investors, we look deeper. The business itself grew by about 8% to 11% during that time. The only reason the stock price didn't move was because it was previously overvalued. The price was waiting for the earnings to catch up. Today, Keurig Dr Pepper is trading at a fair value, offering a dividend yield of over 3%. It forecasts a 15% annual rate of return over the next 2 years as it returns to growth. It fits our portfolio perfectly because it provides steady, reliable income from a product people drink every morning. Next in the foundation, we have J.M. Smucker, SJM. Yes, the jelly company. Sounds boring. And that is exactly why we like it. Smucker is currently extremely undervalued. It is growing earnings at about 4.5% to 5% a year. Because the market has beaten this stock down, it is trading at a price-to-earnings ratio of only 11 when it normally trades at 15. This creates a coiled spring effect. If the valuation just returns to normal, we are looking at a potential 24% annualized rate of return. Then we have Constellation Brands, STZ. This is the largest beer and liquor producer, the owner of Modelo. Like the others, it has been beaten down. The market is pricing it as if it will never grow again. But even with modest growth of 4%, the undervaluation is so severe that it offers a 20% potential upside. And finally, we have Target, TGT. Target has struggled recently. They had earnings issues. They had inventory issues. The stock price collapsed. But the earnings forecast is stabilizing, expecting 5% growth. Because the fear is so high, the yield has pushed up to nearly 3%, and the capital appreciation potential is over 21% annually if they simply get back to business as usual. These stocks, Keurig, Smucker, Constellation, and Target, form the bedrock of our income. They are the defensive line, but there is a problem. Their yields are mostly around 3% or 4%. To reach our goal of a 5% total yield, we need to inject some jet fuel into the portfolio. We need Pillar 2, the accelerator, high yield and utilities. If you want to retire without selling shares, you need cash flow that exceeds your expenses. This brings us to the accelerator. These are companies that pay massive dividends, often 6%, 7%, or even 8%. They are usually slower growing companies, but they act as the income engine of the portfolio. In our constructed portfolio, we had to add a specific stock just to drag our average yield up to that 5% target. That stock was Verizon Communications, VZ. Verizon is a classic high-yield, slow-growth trap for some, but a goldmine for us. It yields 6.67%. It is only expected to grow at about 3% a year. You are not buying Verizon to get rich quick. You are buying it because that 6.67% yield pays the electric bill. However, the market is currently pricing Verizon at only 9.5 times earnings, when it is historically worth 15 times earnings. This means that while you collect that massive dividend, you also have a safety margin. If the valuation just returns to normal, you could see a 41% total return. It was a no-brainer addition to balance the portfolio. Next, we look at the sin stocks. We added British American Tobacco, BTI, and Altria, MO. These companies are hated by many. They face regulatory pressure, but they are cash flow monsters. We bought British American Tobacco at around $54, and it is already up to $58. These stocks provide the heavy lifting on the income side, often yielding north of 8% or 9%. Then we have the infrastructure plays. We included AES Corporation. Some investors worry about the debt levels here, but AES is an independent power producer, an infrastructure play. They generate massive operating cash flows that easily cover that debt. We bought this at a very inexpensive valuation, locking in a high yield on cost. We also have ONOC, OKE. This is an oil and gas transportation company. It yields 5.6%. In this sector, we don't look at standard earnings. We look at operating cash flow, because the capital intensity of building pipelines distorts the normal numbers. ONOC has consistent cash flows that cover that dividend, making it a reliable payer. And finally, the utilities. We added Edison International, EIX. Like AES, it carries debt, but that is standard for the sector. We bought it at $58.42, a very attractive valuation. The purpose of Pillar 2 is simple mathematics. By mixing Verizon, 6.6%, British American Tobacco, 9%, and ONOC, 5.6%, with our lower-yielding growth stocks, we achieve a blended yield of 5.27% across the entire $2 million portfolio. This means our hypothetical retiree is generating $105,000 per year in day one income. But we aren't done. We need one more layer of protection. We need to own the physical world. The third pillar of the never sell portfolio is the landlord. Real estate is the oldest form of wealth, but as a retiree, you do not want to be unclogging toilets at 2 a.m. You want the rent check, not the job. This is why we focus on REITs, Real Estate Investment Trusts. Our crown jewel in this section is Realty Income O. They call themselves the monthly dividend company, and for good reason. They pay you every single month. Realty Income owns thousands of commercial properties, pharmacies, grocery stores, convenience stores. The tenants pay the rent, the taxes, and the maintenance, it is a triple net lease model. Historically, the market loves this stock. It usually trades at a premium. But recently, because of rising interest rates, Realty Income went on sale. We had a rare opportunity to buy it below its intrinsic value. It yields over 5%, giving us monthly cash flow backed by real estate assets. Next, we added VC Properties and VCI. This is an experiential REIT. They own casinos and entertainment venues. Unlike a shopping mall that Amazon might put out of business, you cannot gamble online with the same experience as being in Las Vegas. We bought VC with a 6.3% dividend yield. It is forecast to grow at a very attractive rate, yet it is currently trading at a discount. And finally, for a pure land play, we included St. Joe. This is a different play, more about future growth potential of the land they own, offering a balance to the pure income plays. By combining these three pillars, the foundation, the accelerator, and the landlord, we have constructed a portfolio of 20 stocks that work together like a symphony. The foundation fights inflation. The accelerator provides the cash. The landlord provides stability and monthly income. But how do we know we aren't overpaying? This brings us to the most critical lesson of all, the valuation trap. You might be looking at this list of stocks, Verizon, Target, Keurig, and thinking, why these specific companies? Why not just buy the S&P 500? The answer is valuation. As we always say, valuation matters, and it matters a lot. Let's look at the lesson of Keurig Dr Pepper again. There was a period where Keurig was growing fast, and investors got excited. They bid the price up to the moon. If you bought at that peak, even though the company kept growing, you made zero money for years. In fact, if you bought at the peak valuation, you averaged a 0.14% return over 5 years while the market soared. You took all the risk and got none of the reward. Why? Because you overpaid. In this portfolio, every single stock we selected was trading at or below its fair value. We are contrarians. We buy when the market is fearful. When a stock gets overvalued, the risk increases dramatically. You are basically relying on the greater fool theory, hoping someone else will pay even more than you did. In a never-sell portfolio, we demand a margin of safety. We want an earnings yield of 6.5% to 7% on every dollar we invest. This ensures that even if the market price drops tomorrow, the business is generating enough cash to cover our dividend. Now, I want to clarify something important. When I say never sell portfolio, I mean you never sell to pay bills. But you do sell to protect value. This is not a set it and forget it portfolio. This is not the Ronco rotisserie oven where you just walk away. This portfolio requires management. We must monitor these 20 stocks. If Target suddenly triples in price and becomes massively overvalued, we might sell it, not to buy groceries, but to harvest the profit and move that money into a new undervalued stock, perhaps a utility that is on sale. If Omnicom, OMC, and Interpublic Group, IPG merge, which is a rumor right now, we might sell one of them to avoid overexposure to the advertising sector. We are constantly pruning the garden. We are looking for fundamental deterioration. If a company stops growing its dividend, or if its earnings collapse, we cut it loose. We do not react to stock price drops. We react to fundamental business failures. But as long as the fundamentals stay strong, we do nothing. We sit on our hands. We collect the dividends. Conclusion: the mindset shift. So let's look at the result. We invested roughly $2 million across these 20 stocks. Current value, $2,026,000. Current yield, 5.27%. Annual income, $105,000. This retiree has achieved the Holy Grail. He covers his expenses. He has a portfolio that is diversified across consumer staples, utilities, real estate, and finance. And most importantly, he has income growth. We estimate this portfolio will grow its income by about 6% per year. Next year, he won't get $105,000. He might get $111,000. The year after, $117,000. While his friends are panicking about inflation, he is getting a raise that outpaces it. This is the power of the three-pillar solution. You move from the anxiety of the market participant to the peace of the cash flow architect. If you are approaching retirement, stop obsessing over the S&P 500 index. You can't spend the S&P 500. You can only spend cash, build a fortress of dividends, buy value, and never be forced to sell again. If you found value in this breakdown, subscribe to the channel. In the next video, we are going to look at a different strategy, a portfolio focused purely on dividend growth, for those of you who have 10 or 20 years left before retirement. Welcome to the new way of thinking about wealth.